What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. So a lot of people have been liking this type of video where I discuss news, I discuss earnings, which I have no problem doing. But as always, head down below, like the video, comment, let me know whether you like these videos, what you want to see me look over next. That's absolutely key. And remember to subscribe to the channel. So this week's video, we're going to be focusing on one of the most popular dividend stocks here in Canada. And when I say dividend stock, it's primarily because the company really does not offer all that much outside of the dividend. Growth has been practically non-existent over the last while, and the company is really struggling from a leverage perspective, so much so that BCE, it was cut to one notch above junk by Moody's. So as per the article, which was released early last week, BCE was cut to the brink of junk by Moody's ratings on concerns about the telecom earnings growth failing to keep up with its debt load. So if you have ever listened to me on the TCI podcast, on my X account, if you're a premium member, regardless of any of that, you've probably known that I've been quite bearish on BCE for quite some time due to these debt levels. Now, I'm going to discuss the debt overall, the situation the company is in when in regards to its common dividend, and what I really think the company should do. I don't think they exactly will do it, but I really do think they should be cutting the dividend. But ultimately, when we look to this level of debt, so Bell Canada has consistently moved debt to EBITDA up annually since 2019 and has not demonstrated any commitment to deleveraging while maintaining a dividend growth model. This company has not been able to afford its dividend for going on 2+ years now. And there's a big misconception in the telecom sector where many people say, oh, this is completely normal for telecoms. They go through capex cycles, things like this. This is certainly not normal for it to go on this long. In fact, I pulled data up previously that had highlighted that BCE, this is the first time the company hasn't been able to cover the dividend in a couple years, pretty much since the dot-com bubble. It has been quite a while since the company has been in this type of situation. And I want to speak now on this debt to EBITDA. So the company typically announces a guided leverage target. So when we look to the company's historical leverage targets, we can see that, as of December 31st, 2023, our net debt to leverage ratio was 3.48 times. So regardless of the big idea that a lot of these telecom companies are deleveraging, this is at the end of last year, and this has actually increased. I believe it sits around 3.7x right now, if we go to one of their reports. So yeah, net debt to leverage ratio of 3.7x. Now, the company typically targets 2 to 2.5 times adjusted EBITDA. And what they've effectively done here is just kind of move the goalposts. So the company typically targets this 2 to 2.5x range. And, at the end of last year, they kind of figured out, hey, we're never going to hit this range. So we're just going to bump the target up. So now their new target is, 3x. So they want to hit this 3x range. And the strange thing for me is if you're issuing these targets, if you realize you can't hit your target, it's very strange to just up the target so that you can attempt to hit that higher issue target. Like, I do get the interest rate environment is relatively weak right now. The company is paying a crazy amount of higher interest expenses, but in terms of the downgrade, analysts are seeing this exact same thing. They continue to see this ratio increase. And, despite the mentality that, a lot of people think these companies are deleveraging, I mean, in the case of BCE, they're really not. So in terms of their adjusted EBITDA to adjusted net interest expense ratio, it was 6.94x. Now, ultimately, you want to see this number higher. It pretty much takes their adjusted EBITDA and compares it to their net interest expenses. So the higher the ratio is, pretty much the higher adjusted EBITDA they have to cover that debt level. So their typical target is 7.5 times adjusted EBITDA. Now, what they've done here in an attempt to, what they say is an attempt to simplify their internal targets, they've just completely eliminated this adjusted EBITDA to interest expense ratio. They just don't give an internal target anymore. And we can see that, at the end of December 31st, 2022, it was 8.5x, and now it's 6.94x. So it's continually going down. And the company has just eliminated that target. So they bumped their net leverage ratio from 2x to 2.5 to 3x, and they hope to hit this eventually, I would imagine, in the next year or so. And then they've just completely eliminated another internal debt target that they track. This is ultimately not a good sign. Companies set targets. Those targets are expected to be maintained. If you talk about a target you're going to hit for a long enough time, and then eventually when you can't hit it, you just eliminate it, it is not a good sign. So I am not surprised at all by this downgrade. I mean, even here, sell-side analysts have questioned BCE's strategy of continually growing the dividend even as its growth has slumped. There is effectively no growth here. If we go to the company's guidance, they grew revenue 2.1% in 2023. They expect flat growth to 4% growth in 2024. It's more than likely going to come in at this 0% range. So there's effectively no revenue growth, 1.5 to 4.5% adjusted EBITDA growth. I believe they're in the midline range of this, so they're not expected to hit the low targets, but they're not expected to necessarily hit the high targets. When we look to earnings growth, 7% decline to 2% decline, and when we look to free cash flow growth, 11% decline to 3% decline. So despite these declining numbers, the company continued to raise the dividend. It wasn't really all that big of a boost. It was like a low single-digit boost. But the fact of the matter is, this company cannot afford the dividend right now. Its debt levels continue to go up. It sold off some legacy assets a while ago for $1 billion, and it says that it's going to ultimately reduce its leverage ratio. But the fact of the matter is, it doesn't really look like the company is really deleveraging all that much at all. I mean, when we look to overall debt levels on the year, we can see the company now sits with total debt of $39.51 billion. At the start of the year, this was $34.91 billion. So this company's debt has gone up by 13% this year alone, over $5 billion in debt issuances. When we look to a company like Rogers, they're relatively flat, 2.39%. When we look to a company like TELUS, 6.35% growth. But if we actually look at the chart here, right, we actually seen an overall debt reduction for TELUS. When we look to the quarter ending in March 2024 till now, it's really not that much of a debt reduction. It's about $200 million. But when we look to BCE, I mean, just compared to compared to the start of the year, we're talking about $5 billion plus added to the balance sheet in terms of overall debt. There just isn't the earnings growth or any sort of growth here to back this sort of, debt issuances. And I know a lot of people think that this company is going to, slash capex, lay off more people, sell some more legacy assets in order to, make things a bit more affordable, especially on the dividend front. I'll get to that in a second. But the fact of the matter is, ultimately, this company is kind of chasing, levers that it can pull to kind of improve its cash flow situation. But ultimately, this doesn't really help long-term growth for the company. The much more affordable route right now would be to cut that dividend, get it to the more affordable range, and then the company can maybe, pull some levers in order to fuel growth rather than just pull levers in order to get that dividend back down to some sort of affordability. When we look to the overall dividend, it pays 99.7 cents. It pays $3.99 a year. We have around 912 million in shares outstanding. So really that works out to be around 3.6 billion in common share dividends paid. And when we look to the trailing 12-month free cash flow generation, we're sitting at 2.89 billion. So there's around a $700 million shortfall when it comes to the payment of the dividend relative to the cash flow the company is generating. And another very common thing I hear is, they're not financing the dividend, they're financing the capital expenditures. So they're paying the dividend and then financing more capex. But the fact of the matter is they cannot cover the current dividend with the free cash flow they generate. They need around $700 million more dollars. And regardless of whether this comes from capital expenditure cuts, the sale of more assets, laying off, more employees, any more, internal restructuring, ultimately this is going to impact the future growth of the company. The easier route here, in my opinion, would be the company cutting that dividend, getting it back down to a more affordable range. I mean, when you're paying out $3.6 billion in dividends and you have $2.9 billion in free cash flow, just cut the dividend 25-30%, get that down to a more affordable range, and then you don't have to pull all these levers to try and, get back to just surviving, I guess I would say. And I mean, the market the one thing I will say about these ratings agencies, they're very often late to the party. I mean, they downgraded them now, but the debt situation has been very apparent for BCE for, the better part of 2 years now. We're looking at a peak price of $73.76, and now we're down to $47.53. This is a huge drawdown for a relatively low volatility company. I mean, this is the poster boy for, blue chip Canadian stock, arguably an impenetrable market share. But there's just not really all that much growth here. And I don't doubt that this company might be able to scale things back enough to be able to make the dividend more affordable. But then from a growth perspective, I mean, we've got declining average revenue per user numbers. Again, they own a bunch of lower quality legacy assets that used to be popular and are not really all that popular right now. So they're having to sell them off. They're having to do a ton of restructuring efforts to get back to a, reasonable situation in terms of a cash flow perspective. And ultimately, I think just over the long term, this will effectively destroy shareholder value. This is not positive by any stretch of the imagination. I mean, when we look to returns on invested capital, they're continually going down. I mean, we're seeing returns on invested capital of 8% in 2016. They've dropped down all the way to 3.7%. I mean, they were even relatively reasonable pre-pandemic, but after the pandemic hit, I mean, the company's returns on capital have fallen. Their returns on equity, same thing since 2016. I mean, the return on equity used to be 17.5. It's dropped all the way down to 10.6. And overall, the situation is not really all that good for BCE at this point. Would I be a buyer? It's difficult to say as to whether or not all of this is priced in. I mean, as I said, the stock has taken an absolute thrashing from highs of 2022. From a valuation perspective, we can see, it's trading at 22x earnings, which is actually a premium relative to its 5-year averages. Earnings, they have been hit by a ton of restructuring costs, a ton of interest expenses, things like that. On a forward basis, it's not all that expensive, but I mean, I would still feel 15.7x earnings for a company that is effectively reporting a decline in earnings per share. And, ultimately, lower interest rates might kind of shore up the bottom line and the free cash flow over the long term, but it's not going to help revenue. Ultimately, if revenue is growing at 0 to 4% pace annually, where do we see the improvements moving forward from that? It's not going to come from lower interest rates, I'll tell you that much right now, because that won't help the top line. It might help the free cash flow. It might help the net income, but it won't help the top line. So ultimately, this company can only pull so many levers until, it needs that top line to grow to be able to grow earnings. And if we look to analyst estimates, they're fairly bearish on BCE as well. I mean, we're looking at expected earnings of $3 in 2024. This would be a decline from the $3.18 they made in 2023. And again, $3 in earnings versus a near $4 dividend. When we move forward to 2025, they expect, flat earnings again. And then when we move forward to 2026, again, it's very hard to predict 2026 earnings, but there's effectively no growth here. There's very little growth from a revenue basis, from an earnings basis, from an EBITDA basis. And I mean, again, at 15.7x expected earnings, this company really doesn't look like all that much of a bargain right now, unless it can see some sort of improvements to the top line. Because again, if revenue isn't coming in, eventually you can only cut CapEx, you can only lay off so many employees, you can only sell off so many legacy assets until you have to grow that top line. And with just the overall state of the Canadian telecom industry, I just can't see BCE vaulting to, even mid to high single digit revenue growth in the future. So for that reason, in my opinion, I really don't feel that the company is all that much of a bargain right now, despite, a lot of people believing just because it's down, 30 some percent, it's some sort of bargain. Even if we assume next year, let's say this company boost this free cash flow to, let's say, $3.2 billion. They're trading at a market cap of around $43 billion. So when we divide 43 by 3.2, they're trading at around 13.5x their expected free cash flow. Now, they haven't released any sort of guidance. This is just complete estimations by me. But if we look at trailing valuations, their 10-year average is around 17. I would not factor in 10-year averages whatsoever here. I mean, we're talking about post-financial crisis over the last decade or so. We'd be going back to 2014 when policy rates were much much lower. I really don't think the company is going to get this valuation multiple moving forward unless rates come down in a big way. Even this 5-year average, I mean, multiples are likely a little bit higher inflated because of the interest rate environment we were in during the COVID-19 pandemic. So, I mean, I would say 14 or 15x free cash flows might be a little more appropriate for the company moving forward. And that puts it at a slight bargain if it were to improve those cash flows to that number that I even, just outright guesstimated. We'll have to see when they issue the guidance. I mean, a lot of people last year expected the company to pump out a big increase in free cash flow in 2024, and they came out with guidance that, ballparked a possible 11% decline. So overall, I mean, I'm really not all that surprised that the company has been downgraded by Moody's. Again, they're a bit late on stuff like this, but ultimately this was kind of inevitable. I mean, will they get downgraded again? I'm not exactly sure they will, because the one thing is they did move its overall outlook. They downgraded, but they moved its overall outlook from negative to stable. So at this, credit rating, they do believe that the company is relatively stable. But if they got downgraded one more time, they would hit that junk level, which is ultimately not a good sign for the company. Overall, I think this company should just rip the Band-Aid off, cut the dividend, get back to a better capital structure, improve the balance sheet, and just overall try to pull some levers in terms of actually fueling growth in the future, other than just, pulling these levers just to try and survive, even though, clearly they're not. They're going to be having to fund a large portion of the dividend in 2024. Who knows what's going to happen in 2025? I would expect a lot more pressure if the company issued 2025 guidance in which, the free cash flow cannot cover that dividend. And, considering the company is expected to fall short on dividend payments by, 26, 27% in 2024, it's going to have to improve its free cash flow situation extensively in 2025 just to be able to afford the dividend. But that's my thoughts. Hope you liked the video. Head down below, subscribe to the channel, like the video, drop a comment down below. Let me know if you're buying BCE right now. Let me know if you sold the company. Just let me know your thoughts on the company. I'm really interested. Obviously, I have my thoughts. My thoughts are my thoughts. I know a ton of people who are bullish on BCE, and I want to hear from you too. So head down below, drop it in the comments. And as always, we'll see you next time for more great Canadian content.